How am I supposed to know how I'm doing? What are some metrics investors should be looking at?
This is what I'll tell you. You know, a lot of times I think we all want to have something to go through to gauge by, right? In order to make that change or that goal, you need to have a really clear picture about where you evaluate your risk, evaluate your cash, evaluate your cash flow. What sort of things kind of come into play? What are the goals you want to do? The biggest thing is looking at risk, looking how your portfolio is allocated, and is that going to help you get to where you need to be? Welcome to Wealth Strategies Unleashed with Concenture Wealth Management. I'm Robert Gilliland, and with me today we have the talented
Mike Alexander.
Hey, Mike, thanks for joining us again this week. It's always fun when we get together.
Absolutely. And I know that we didn't talk about this before, so I'm going to surprise you today because I've got some questions because, you know, I get to travel around a little bit, and when we get to this time of the year, I have a lot of folks that'll ask me, they're like, you know what, Mike, I mean, how am I supposed to know how I'm doing? I mean, in your experience, like, what are some metrics that investors should be looking at when they just plot out kind of like, where am I and how am I doing?
That's a really good question. And
I hope I didn't catch you off guard, by the way.
Kind of a little bit. I was going to go a different route, but hey, we'll run. This is what I'll tell you. The first and foremost is I'll tell you the metrics that you don't want to follow. The metrics that you don't want to follow is that of the market. Call it the S&P 500. Here's why. If you go and look at last year, 7 companies drove the market. If you took those 7 companies out of the S&P 500, your return was about half. Okay? So what you don't want to do is constantly be gauging your return versus that of the market. In a roaring market, odds are your portfolio is not going to beat it. What you really need to be doing is basing how you're doing off of the outcomes that you're after and your progress towards that, right? So if you go through and you think about planning for retirement, you need to have X number of dollars. You've got a 5-year time horizon. These are what your income streams are. This is how much money I totally need to be able to do this to ensure that I don't run out of money and keep track of it kind of along those ways. So one of them is what's your progress towards the outcomes that you need. And you can get statistical. We run it as a statistical analysis for our clients to kind of go through to, as you well know, to go and determine, okay, look, we're ahead of schedule, we're behind schedule, what sort of course changes do we need to make? It's really what I realized a long time ago is everyone wants their investment portfolio to do well. The reality is that sometimes the investment portfolio getting you outsized returns is not worth the risk because it's not going to change your lifestyle. It's not going to change your goals. It's not going to change what the outcomes are because at the end of the day, everything reverts back to the mean. So number one, when you're going through looking at the performance of your portfolio and the metrics, what you need to do and that you need to be looking at is how are you doing versus your goals? What percentage of the way are you complete on accomplishing those? Does that make sense?
It makes perfect sense. Now you bring up an interesting point because you mentioned I think the key word which is risk, and perhaps that's the reason why somebody doesn't want to own only the 7 stocks that have been leading the way.
Right.
How do you quantify that? How does an investor figure out how much is an appropriate amount of risk?
There's more magic than art to the answer to that question.
But you are the magician.
Because when markets are going up, it's easy, right? It's when markets go down is when people go through and realize that there are issues and things that you've got to be prepared to deal with, right? Making sure that you have cash that's available and things like that. I think that it is being able to honestly answer, I'm 5 years away from retirement. If my portfolio were to go and drop by 20%, take $1 million portfolio, and I wake up the next morning and it is at 800,000, do I have some indigestion? Am I going to go through and change the way that I'm going to invest this portfolio? If I'm 2 years out Is there something that I need to do? Now, that doesn't necessarily mean you need to get more conservative, but it's really interesting when you go through periods of the markets doing really well. I remember back in 1998, I had a client who told me that he had a portfolio. It was nothing but quality blue chips. It was Intel, Netscape, all these big Yahoo, all these big technology companies.
Some of those names ring a bell.
Yeah, Enron, they no longer exist, but they they thought that they were big blue chips and they didn't have anything to worry about. In the case of Enron, as an example, as we all remember way too well, WorldCom was another one of those. Those companies just do not exist, right? Or at least not in the form that they were, and they lost their value. They went out of business. So I think that if you need to understand what it is that you own and why you own it in order to be able to be successful. So one of the metrics I guess we could go and say is to go through and look at the portfolio and understand, what is this strategy designed to go and do? Does that make sense?
It does. And how often does that need to be reviewed?
I mean, I think once or twice a year.
Okay.
It doesn't need to be done every day, but when you have a big run and then you start to have some volatility, if it starts to give you a little bit of pause, well, then maybe something needs to go and change, right, in the way you're managing the portfolio. I would say, kind of taking away from investing, not dismissing your question, of course, but
of course not.
I think a good metrics that people should be looking at is their budget and their debt load. Right? One of the things we've seen is that credit card balances have gone up here over the last, call it 12 months. Making sure you understand your cash flow, what your budget is, how much are you spending. Clearly, we're all spending more for groceries, more for gas, more for eating out than what we were 2, 3, 4 years ago, right? But understanding what percentage of your budget is being affected by that. That's a good metrics to know whether or not you're in sound shape. And if you have to make some adjustments, you can, right? And that's the thing, is you want flexibility to be able to make those adjustments. Another metrics that I think that people should look at is their savings rate, right? It's always astonishing to me to talk with people and say, how much when we're going through doing a plan, how much you put in your 401k? Oh, I do the company match. The reality is that you really could and should be doing a lot more, because that company match is just lagniappe, as they say in South Louisiana. It's just extra. The tax savings that you get if you're doing them in pre-tax contributions is huge. So evaluating what your savings rate that is inside there becomes really, really, really important. Kind of with that, I'd throw this question back on you. What sort of metrics do you think?
Well, as you know, I typically look at things from the investment side much more so than perhaps the planning side, although I will say that the two definitely go hand in hand. But I think once we get to this time of the year, I typically think of things as, do I have any, what is my tax liability? Am I going to have to actually step back and give up some of these gains that I've got in the marketplace? Am I going to have to pay those? When do I plan for them? A lot of times, I typically think a lot of people are kind of harvesting gains and losses in the month of December, just trying to offset things.
Right.
That can sometimes lead to some additional volatility. So I typically will think, gosh, do I need to start doing some of this maybe a little bit earlier? Are there other things that I need to fund maybe for next year? So an example might be, looking at my cash position and say, okay, if I have certain cash needs that I'm going to have for next year, and I already know those, should I start earmarking some assets for those? And so making sure that I've got that, that safe money, if you will, that's not really going to be invested, making sure that that's exactly where it needs to be. And by the way, if there's too much there, then also having the opportunity to commit to some of that to longer term investments typically will make some sense too.
When you're going through staying on the investment theme, I realized that you were on the investment theme, and then I derailed us, and then now we're back on the investment theme. The one thing also that I think makes a lot of sense, when you've had years that markets have been really, really good, it really makes sense to go and look at what your allocation is. If you're a moderate investor, well, you should have X percent in stocks and X percent in bonds and X percent in cash. The last 18 months have made it so that if you didn't make any changes, you now have a lot more in stocks than what you do in bonds. Who knows where you are on cash, right? And just looking at that, you may actually be a lot more aggressive than what you are comfortable with, right?
Absolutely. And you bring up a really good point in terms of just that rebalancing part, because again, one of those metrics that I always think about is, and I think you said it earlier, which is kind of reversion to the mean. And if the S&P was up 20+% last year and it's up almost 20% this year, history suggests that I'm not just going to continue to clip those kinds of numbers. Yeah. As a matter of fact, I'm probably going to have a really low return, if not negative, at some point, just to get back to the long-term average. And so I think one of the things that I'm always thinking about is, and it is a metric, if you will, is just to say, how far ahead am I relative to where I'm supposed to be? So as you know, when you're working on plans, it's like, okay, if everything is working according to plan, this is where we should be at this time. We're a little bit ahead of the game. Maybe the metric then is that I want to look at is I want to make sure that I'm not taking on too much risk, as you just suggested.
In those scenarios, we basically clip off some of the risk, if you will, and look to fund other goals or other cash flow needs, and look to see what our time horizons are, because we tend to stay at the mean. What's interesting, a lot of people don't realize, from 2001 till 2010, you really didn't make money in the market, right?
Right.
So you really didn't make, I think it was 1.7% in the market. That's a long period.
It's an eye opener.
Yeah,
it's an eye opener. Let me ask you a question, and this is not relative to the financial side, but relative to other metrics that are maybe non-financial. So tell me how you discuss with clients, employment, or maybe their job situation. Is that going to change? Maybe they've decided, because markets have done really well, that they want to move forward their retirement. I mean, do those types of conversations happen on a regular basis, and do you have a metric for thinking about that?
Well, generally thinking, when people are looking at the opportunity to that there may be a layoff or a reduction in force or something like that, that's when sometimes some panic kind of sets in. And the very first question I have them is that, do you want to go, assuming that the numbers all work, do you want to go back to work, or do you want us to start thinking about retiring? And what exactly does that mean? I think when you're looking at potential volatility in the workforce, I think one of the things that goes back to evaluating the cash that you have off on the sidelines, so that you can maybe, if you think that that there may be a reduction in force at your company, making sure maybe you're comfortable having 3 to 6 months worth of living expenses, maybe you build that out to 6 to 9 months of living expenses. That way your lifestyle doesn't have to dramatically go through and change, right? The other thing is that because of where the markets are, there have been a lot of people, we've had a lot of conversations where they're looking at moving up that retirement, right? Do I have enough money? How do I create that cash flow? That's where just sitting down and having a conversation, assign probabilities of success to the outcomes that you need or want to have, and have a real serious conversation, not just the fact that you think the market's going to go up 20% per year. And so evaluating that inside of there.
Any others that we're not thinking about, or ones that maybe come at you from out of left field from time to time?
A lot of times I think the answer to that is no. I think we've covered them. The thing that's interesting to me about you bringing this up is that we all want to have something to go through to gauge by, right? And generally speaking, that's your New Year's resolution. That's when you're going to go and say, okay, this year I'm going to save this, or I'm going to do this, or whatever, right? I'm going to lose 20 pounds, whatever. The reality is in order to make that change, or that In order to make that change or that goal, you kind of need to have a really clear picture about where you are. Evaluate your risk, evaluate your cash flow. If you're still working, evaluate your best you can, the ability that you have job security. What sort of things kind of come into play there? What are the goals you want to do? Pay attention to that. The biggest thing is looking at risk, looking how your portfolio is allocated, and is that going to help you get to where you need to be? It's much more important to say, I need to be here. I've got 5 years to get there. I'm 85% of the way there. Am I in good shape? And understand what exactly that means. That to me, when you're looking at outcomes of your financial picture, financial life, that seems to kind of be the key.
Well, first of all of those very, very helpful points. Anything else that we're leaving out? No, I'm sure there's plenty, but
we could probably make some up.
We tackled the big ones, right?
We could probably make some up.
Well, I really do appreciate you lending me the opportunity to ask the questions this time. As a matter of fact, allowing me to hijack the conversation today. But I had some things that were kind of on my mind that I wanted to throw out your way and
well, it was
and
good,
get
but
your
I
take
really
on.
would like a little bit of advance notice next time. But hey, we'll deal with it.
Not a problem at all. Well, thanks again, and really do appreciate it.
Perfect. Thank you all for joining us on this week's edition of Wealth Strategies Unleashed. I look forward to seeing you next week.
The information contained herein is intended to be used for educational purposes only and is not exhaustive. Diversification and/or any strategy that may be discussed does not guarantee against investable losses, but are intended to help manage risk and return. If applicable, historical discussions and/or opinions are not predictive of future events. The content is presented in good faith and has been drawn from sources believable to be reliable. The content is not intended to be legal, tax, or financial advice. Please consult a legal, tax, or financial professional for information specific to your individual situation.
This work is powered by Concenture Wealth Management, registered representative of Sanctuary Securities, Inc., an investment advisor of Sanctuary Advisors, LLC. Securities offered through Sanctuary Securities, Inc., member FINRA, SIPC. Advisor services offered through Sanctuary Advisors, LLC, an SEC registered investment advisor. Concenture Wealth Management is a DBA of Sanctuary Securities, Inc. and Sanctuary Advisors, LLC.